Welcome to the CEC Report. It's the 3rd of March. I'm Robert Barwick and I'm joined by CEC leader Craig Isherwood. Welcome, Craig.
Yeah, thanks, Robbie.
In this week's CEC Report, how many bankers breaking ranks does it take to get Glass-Steagall? And media scrutiny sends shudder through Australian property market. So how many bankers breaking ranks does it take to get Glass-Steagall? Craig, it's probably not obvious in the Australian media, but there is a massive global financial crash erupting around the world as we speak.
I think the desperation, Robbie, to report good financial news is rather evident on the major news channels.
That's
any
right.
hint of any good news is covered pretty quickly.
And when we get onto the property story in the next segment, we'll see just the reaction to that is a living example of how nervous the media actually is.
Well, yesterday, the government was crowing about the fact that GDP increase, the overall increase in GDP was 3%. The economy grew by 3%. But when you have a look at underlying where did that growth come from? Well, first of all, it was a 0.8% rise in household consumption. So people are spending more, right? The 6% surge in public investment, so the government's been spending a lot more money to offset the mining boom, but also in things like rental, hiring, and real estate. So you look at where this jump is coming and say, well, where is the increase in actual real productivity? And it's not there. Yep. But this was enough. This good news was enough, so-called, to jump the stock market back up into the green, and everyone was applauding and so forth.
And all those categories you just cited rely on borrowed money.
Yeah.
And that's part of the crisis we're coming into. So just look around the world, though, places like Europe, the United States. We'll just give some predicates before we get onto the question of Glass-Steagall. Citigroup, which is probably the biggest bank in the world, they are worried, and they've put out an analysis which expresses real worry that what they call the primary market for investment-grade bonds has been freezing up over the past 12 months. So bonds are what organisations or governments issue to borrow money, right? And on 75 days, in the last 12-month period, so 75 days out of those 12 months, no new corporate bonds were sold by anybody. And this figure of 75 days when no bonds were sold, that's a higher figure than was seen during the 2008 financial crisis, right? So what it means is the bond market, people in Australia and most people wouldn't appreciate, the stock market gets the headline news. The bond market is far more fundamental to the financial system. This is a big deal.
This is where corporations, Robbie, like places like BHP or Apple Computers, will issue these bonds, these coupons. They might issue $1 billion if they're that big, or $500,000 worth of bonds that people go out into the marketplace. They buy them, and these bonds have they've got a specific return on them, which the companies then pay back, and at the end of the time they pay back the entire bond. It's very similar to government bonds, but these are issued by rather large private corporations.
But the news service, Craig, called Bloomberg, points out the obvious, that if there's this problem in the primary bond market, it can flow into the secondary bond market, which is when these bonds are resold, because they're quite liquid things. You can sell them and resell them all the time. And then that would, quote, create the potential to create contagion if companies find they are unable to finance existing debt, because that's actually what bonds are for, right? So that's a real sign of worry. That's a canary in the mine. Another canary in the mine is the sales in the junk bond market. Now, junk bonds, that's a terrible name, but it means high yield. It's usually for shorter term stuff, often more speculative stuff though. Riskier, but they're willing to give a higher interest rate to get it. Junk bonds are a big part of the financial system now. Not that they're that great, but at the moment, the value of new bonds issued since the beginning of this year is 75% lower than the same period in 2015. So in other words, no one's issuing these things effectively, right? This is a sign of a financial system that's freezing up.
Well, that's a bit of a worry, because, Robbie, these bonds have a set period. They're not bonds that go on and on and on, although there are some types of bonds that do that, some perpetual bonds, but they're very rare. These have got a maturity of 3, 5, 10, or whatever years. So when you get to that 5 years, you've got to roll these things over, because there's no other source of income.
The company can
capital.
The company can very rarely pay out the principal at the end of the time, so they've got to roll them over, right?
Otherwise, they've got to come up with big money. And if you've got a company that in a poor economic situation, a poor economy, where are they going to find that capital?
So just those couple of predicates there, they are similarities to 2008, right? Anyway, what we're now seeing more and more of is experts, people that have all the credentials in the world, coming out and saying the two magic words, Glass-Steagall, because we've had too much resistance to this for too long, and there's more and more voices being added to this call because it's the most sensible thing in the world. And so the question I posed at the beginning, Craig, is how many is it going to take of these bankers breaking ranks on this issue to call for Glass-Steagall? Because they are breaking ranks. The majority of bankers who still have their fingers in the pie don't want it because it'll reduce their profits, but it's supposed to. It's going to make the system safer. So the latest is the Bank of England Governor, Mervyn King. Now, he's actually called for Glass-Steagall before. It's just that, well, he's the former Bank of England Governor, until 2013. He's just released a book called The End of Alchemy. And alchemy, remember, is the term for the belief in ancient times that you could turn something into gold, right? And derivatives trade is based on that mentality. There's no doubt about it. But that's behind the scenes, behind the curtains, they're just stealing from everybody. Mervyn King has just declared that another financial crash is certain. Not probable, certain. And the reason he cited is because the banks have not been reformed. So with all he's saying that even though you've had all the laws passed, Dodd-Frank in America, the Banking Act in the United Kingdom, he says the banks haven't been reformed. He also added the Eurozone, for similar reasons, is doomed to fail. But I just want to read you the quote from his book, The End of Alchemy, where he calls for banking to be restructured to remove the alchemy from the financial system by returning to Glass-Steagall. King notes that, quote, the Dodd-Frank Act passed contained 2,300 pages, with many thousands of pages more expected to cover the detailed rules that will follow, and that, quote, in Britain, the Prudential Regulation Authority and the Financial Conduct Authority have combined rule books exceeding 10,000 pages. And I believe, Craig, you have a graph to illustrate the consequence of that.
Well, yeah, I mean, one of the amazing things, Robbie, is that if you have a look at the number of employees employed to oversee the banks, Andrew Haldane, who is also involved as the Executive Director of the Financial Stability section of the Bank of England, he came up in a paper a couple of years ago and said that up until the 1970s, there was only basically 30 employees in the Bank of England that were given the responsibility for oversight for the banking system, and then that increases to 80 in 1979 when the actual Bank of England was given formal responsibility for oversight of the banks. But since all these millions and millions of pages of, well, millions, but thousands of pages of legislation have been introduced, what's also happened, there's been a massive increase in the number of people needed to enforce these regulations. Whereas back in the 1979 period, it was one person for every 11,000 employees. Now it's one person for 300 financial industry employees.
So it's a paradox, though, because you've got all this extra body of people looking over the shoulders of the banks, supposedly, yet less effective regulation of the banks, because look what they got into.
That's the problem, and it's the same in the UK as in the United States, and it'll be the same here. You have these massive bureaucracies, so-called regulating the banks, but they've actually got less regulation in many respects than they had. Say, if you go back to World War II, where you had a Commonwealth Bank in this country, actually regulating the bank because you had Glass-Steagall type regulations in place, which meant that the banks couldn't get into this giant speculative casino industry that they're in today.
Well, let's come back to what King says. So he goes, despite all this quote-unquote frenetic activity that you've just illustrated, nothing fundamental has changed. The alchemy of our banking system remains. And then he said, in stark contrast, quote, the Glass-Steagall Act of 1933, which separated commercial and investment banking, covered a mere 37 pages. And he's advocated Glass-Steagall since 2010, where he said, quote, only a fundamental rethink of how we as a society organise our system of money and banking will prevent a repetition of the crisis that we experienced in 2008. Otherwise, quote, another crisis is certain sooner rather than later.
I think, Robbie, it's interesting to see, look, what did Glass-Steagall do? It basically says that commercial banks cannot be involved in this.
Yeah.
So instead of having regulations
with this exception, with this exception, with this exception, with this exception, with this exception.
It was, you can't do it.
Black and white.
End of story, right?
Yeah.
And that's what we don't have today. We have this, yes, you can do it, but you've got to follow, 1,000 pages of rules and these sort of conditions. And they're trying to predict the conditions within which to have the rules.
And all it does is it's a boon for lawyers, right? And for the kind of traders that like to find a way between the wallpaper and the wall, as they say, that bankers are good at. Now, just quickly, and just to mention, because it was a bigger deal in the United States that we didn't get to talk about last week, Craig, on the 16th of February, the chairman of the Minnesota Federal Reserve, there's 12 Federal Reserve branches in America, he called for a massive increase in reserve requirements for the too big to fail banks, which he said should be put in the same category as public utilities, right, like electricity systems, which provide services that must be absolutely reliable. And under those conditions, he said the banks would be required to hold, get this, 30% reserves for all their lending. Now, 30%...
They're reserves, they're not assets.
That's right.
And
that's
reserves,
money.
That reserves,
against all
that
their
means
lending.
that money that's, or assets that are quickly convertible. That means government bonds that can be sold quickly. It means cash. It means gold. It means those sorts of instruments, Robbie. Not housing mortgages or other sorts of
So how does that?
assets.
So how does his call for 30% compared to Australia's banks?
Well, most of Australia's banks have this rating called a CET1 ratio, which is called, it's a common equity tier 1 ratio, where you measure risk-weighted assets of the bank. You look at all the assets of the bank and you risk-weight them according to what they are. Now, housing loans are risk-weighted at 50%, so you can count 50% of your assets that are housing loans as 50% of the value of your assets.
So under that, what do they claim the reserve is?
Just a bit over 10%.
And what is it? And when you do the risk weighting fiddling, what is it actually in reality?
Well, it's about 4%.
So in practice, Australia's banks are at 4%, and this guy from the Minnesota Fed is saying for banks to be properly sound, it needs to be 30%.
That is unbelievable. During the war, the Australian banks were about 20%, and that was by law, under the regulations required. So,
well, this man, Craig, I have to mention, he's a former Goldman Sachs banker. He oversaw the TARP bailout, the $700 billion TARP bailout of America's banks. And so he's come from that side and he said, look, everything's made me change my mind. This is the only way to ensure the system. And when they said, well, this is going to split the banks up, and he said, good, I'm not opposed to Glass-Steagall, right? So everyone's coming to this, well, every sane person's coming to this conclusion. It's got to happen, and it's got to happen fast. We're out of time on this. Let's take a break and come back and talk about the property bubble.
You've been watching the CEC Report, the weekly TV show of the Citizens Electoral Council of Australia. What can people do to find out more, Robert?
Well, they can get on our website, www.cecaust.com.au, or they can call our toll-free number, Lisa, to order a copy of this, the Australian Alert Service, which is our weekly publication where we write up all the material we use. That number is 1-800-636-432. Welcome back to the CEC Report. Media scrutiny sends shudder through the Australian property bubble. Craig, there was extraordinary events, sort of probably subterranean to most people. It didn't get it got coverage in the right places, but wasn't on the front page of the lead item on Channel 9 or anything. So you had a story on the Australian property market. It was on 60 Minutes, right? And that was two Sunday nights ago, the 21st of February. And what they did is they showed the town of Moranbah in Queensland, which was a thriving mining town where properties had been selling for over $1 million, and now that's all crashed, and a lot of people have been left carrying a lot of debt. And then the story shifted to Western Sydney, where they had these experts come in from this one analyst, Jonathan Tepper from the UK. He came in and he basically did to Australia what the Big Short movie talks about happened in the United States. And it got a lot of attention, and he made some big comments. Like he pointed out, for instance, that Australia's bubble, he said, this is a bubble here, there's absolutely no way it's not a bubble, and it's going to crash. He said that's inevitable. And he pointed out certain things like 50% of mortgage loans at the moment are interest only, right? That's what the banks have to do to keep lending money to people, because people can't afford it otherwise. That's at record low interest, by the way. Mm-hmm. To be able to fill this bubble. He also said that this is going to crash by 50 to 80%. So this got a lot of attention. 2 days later in the Financial Review, it got even, they covered the story as well, his analysis. It got even more attention. So on the screen, you'll see the graphs that the Sydney Morning Herald covered this itself, and they put these charts up there that Tapper's organisation, Variant Perception, supplied. So the first one shows in Australia, it's called House of Cards, residential mortgages as a percent of total loans. And it speaks for itself. What that means is more than 60% of all loans issued by banks in Australia are mortgages. And in case you thought that was normal, compare it to the rest of the world, right? Our banking system is entirely concentrated in this one sector of the economy. So if it's in trouble because it's a bubble, it's not just your property that's in trouble, it's the banking system that's in trouble. That's what that shows. The next one illustrates his report that more than 50% of lending at the moment is interest only. And like I said, that means that the borrowers can't afford these properties, so the banks have to do all these tricks to make it affordable for them, right? That's a real worry. And you see the way that's risen since 2011, where it's gone from a little over 30% to now over 50%. The third one, Australian real housing sector indices. And what you see there is the growth in overall prices starting after 1998, going up a little bit, going down, and then starting to zoom just before 2002 there, with a few jumps to the heights that it's at today. And that dichotomy between prices and household income, rents, and all the other metrics that are relevant to it. And similarly, the next chart, household debt as a percent of GDP. If you can compare us to the average in the world, look where we are at. We are the most indebted nation in the world in terms of household debt. All these are bad signs. And on that basis, Tepper was saying this system is going to crash. It has to crash. Now, when he said that, Craig, and when the Financial Review reported it in that morning of the Tuesday the 23rd, all hell broke loose in the Australian financial system. And I'll just go through the predicates quickly and then we can discuss it. Christopher Joy reported this in the Fin Review last Saturday, the 26th of February, where he said the reaction of financial markets was, quote, astonishing. First of all, the share price of the big four banks plunged by 4% in one day. It just sank 4%. And that wiped out about $15 billion there for investors. A European investment bank told its clients that there was, quote, massive short-selling interest in the major Australian banks, and it all seemed to be based on misplaced views of Aussie housing, which was triggering, quote, mayhem. Hedge funds rushed into these derivatives called credit default swaps. Now, they're insurance derivatives that basically means the buyers are betting the bank will default or even crash. Right? So there was a rapid buy-up of these credit default swaps on Australia's big four banks on that day, and it prompted one player to comment, quote, the action in bank credit default swaps today would make one think there is a bank run going on in Australia. The credit default swap prices on the big four banks increased by margins that were last seen in 2008 during the global financial crisis at the height of it, when our banks were on their knees. Wall Street got in on it. They started buying up these credit default swaps as well, Craig. In fact, they did it so much, it pushed up credit default swaps on all Australian companies. And then Westpac that day wanted to borrow money from the market by issuing bonds, basically. Yeah. And you take the interest, people bid what they're going to pay, what they want in interest if they're going to lend it to you. It was forced to pay 3.10% higher than the normal bond rate on that day because it tried to borrow money. And Christopher Joy called that global financial crisis like interest rates. That's what happened last week in the Australian financial market on the basis of this one story. So let's take a quick break, and when we come back we'll discuss the significance of it. Welcome back to the CEC Report, where we're discussing media scrutiny sends shudder through the Australian property bubble. And Craig, we were just talking about how there was this absolute carnage in the Australian banks last week on the back of one story, effectively, that like the movie The Big Short, these guys said, look, that applies to Australia as well. Now, the the people whose analysis was the news, this Jonathan Tepper and a hedge fund called Bronte Capital, they were then accused of doing a drive-by. And a drive-by basically means that they're betting against the property market and then talking it down so it does crash so they can cash in on their bets. And it turns out, from what I've been able to confirm, that's true. That's what they were doing, right? And that's similar to the Big Short, except in the Big Short, those gentlemen weren't talking down the market. It was going to happen. These guys are being accused of doing it more cynically. However, I would maintain this. They bet against a nag dressed as a champion racehorse, right? Because the analysis that they base their insight on is the same analysis we use. We've been saying this for a long time. So my question to you, Craig, would the media scrutiny have had this dramatic impact that it had if the main players involved aren't already worried that the whole thing's a house of cards and ready to collapse?
This is a signal of the global financial crisis, Robbie. It's a signal of the nature of when you're in a global casino economy. I want to just put on the table that when you look at this, actually the first graph that we put up on the screen, this question of residential mortgages as a percent of loans, is the actual key.
Yep.
Because in any healthy economy, right, you have to see where is the credit going.
Yep.
Now, immediately you see 62% on whatever it is of bank lending going into residential mortgages. You can see that, and all these graphs are basically shadows of a bigger policy, which is the reason why everything's going to crash. And that is the credit that's being created in the economy is not going into support productive activity, real manufacturing,
yeah,
real jobs, real food production, real development of necessary infrastructure. Rather, it's being spent into what we call necessary overhead in the case of houses. But it's been spent in such a way that that overhead is becoming even more of an expense to the economy because it is not productive. Yes, you do need houses for families and your productive units, but when it becomes...
Which is why we call it necessary overhead.
That's why it's called necessary, but when it becomes a speculative bubble, such that you're getting 50% of interest-only loans for speculators to go into invest in this vital area of the economy, then that becomes more and more like financial overheads, accounting, banking and so forth. They're parasitical on the economy.
So if 62% is going into housing, what's not getting credit?
Well, exactly. Well, it's 38% being lent to the rest of the entire economy. Now, it should be completely inverted, like around about 25%. Fine, the banks can lend for residential mortgages where it's, if you go back to where houses are only basically 3 times the medium household income, that's what's recommended in terms of the
whereas in Sydney it's 12 times at the moment.
Here in Melbourne it's 9 times, right? That's completely unsustainable, therefore. That's why you're getting a lot of people going to interest-only loans, is because they can't pay 12 times the medium household income. You look at the household income, what's that made up of these days? That's made up of 2 people working to try and survive that mortgage, because that mortgage is 9 times that household income. And then you look at the amount of money that's spent from that income that's coming into a household, it can be up to 60, 70% of that family's income is being spent just to service this particular bubble. Now, when the money and the credit is directed this way, so that you're literally propping up overhead expenses in your economy, the economy is going to crash. It has to crash. Yeah. And we are seeing that with the crash in manufacturing. We're seeing it with the desolation that's taking place in family farming. We've seen it already. The mining industry has already crashed. Where does that leave Australia in the next period? In a very serious condition. So we need to get back to policies of funding and directing credit to real productive economic.
And that's where a national bank comes in, because again, look at the graph. If you have a national bank, it can provide the credit to all those other things that are missing out on the way the system is structured.
And
now.
we cover all this in our Australian Alert Service, Robbie, in detail, so people need to get copies of that.
Yeah, call in, get yourself a copy of this week's Alert Service where we elaborate all this. So that's it for this week's CEC Report. Thanks, Craig, for your insight. Thanks for tuning in, and tune in next week for more of the CEC Report.
You've been watching the CEC Report, the weekly TV show of the Citizens Electoral Council of Australia. What can people do to find out more, Robert?
Well, they can get on our website, www.cecaust.com.au, or they can call our toll-free number for Lisa to order a copy of this, the Australian Alert Service, which is our weekly publication where we write up all the material we use. That number is 1-800-636-432.